Hi, everyone. I'm Asaf Nadler, and I'll be moderating this panel. Stanley, John, Chetan, Charles, thank you so much for joining me today. Let's start off with a kickoff question. The panel is called Capital is Selective, again, implying that there was a time in which it wasn't. What changed when you're looking at the current market?
I'll jump in then maybe. I think if we're talking about crypto, it's been a big evolution over the last 10 years. So obviously when it started, it was super innovative, breaking new grounds. 2017, the ICO boom, all you needed was a white paper and a vision, and you could raise a lot of capital. Obviously that unwound when it was obvious that not all those products worked. Then we had 2020, a lot of new innovation, DeFi summer, and DeFi in general was really exciting, GameFi, NFTs, etc. Unfortunately, that unwound as a lot of that didn't really have product market fit, and we also then had a lot of problems in the space, frauds and FTX, dozens of platforms went down. So I think trust was lost in a lot of projects generally over that time frame. Retail didn't really come back in the last few years, but at the same time we've had institutionalization, which is really exciting. Long story short, I think the only products that really fit now are those that have revenue and strong tokenomics. And if you simply filter on those two things, that will eliminate 99.999% of tokens. And we still need to regain retail trust. And that's been a bit challenging, I'd say, in the last few years, given that meme coins and scams and pump and dumps have probably taken a lot of capital out of the market and hurt trust. So we kind of really need to focus on those projects. A few obviously come to mind that have achieved that. And so that's kind of why capital is more selective now, I think, is people don't trust a lot of those valueless tokens, and it's all concentrating on the projects that really have longevity and actual growth.
I think from Franklin Templeton's perspective, by the way, thank you for having me this morning. I think what you're seeing, if you leave aside the price movements that you've seen in the last few months, that's all a part of it. It's a reflection of what's happened with greater institutional participation, greater launch of products like ETFs, trades being potentially unwound. I mean, it's just part of a healthy market evaluation and discovery process. But if you look at real-world assets, which is where Franklin Templeton supports both the investment side on the native crypto side of the business, as well as the push on the real-world asset tokenization side, not much has changed, to be honest. It's actually grown. There haven't been any major disruptions from participants that we at least know of, and the projects are continuing. So we are seeing the uptick in stablecoin issuance. We've seen the uptick in real-world asset growth, and we will continue to push on those launches on different chains and where it makes sense. So from an institutional mindset, I think the advantages that blockchain can bring on capital selection, to be quite honest, hasn't really changed that much.
I think it's a story of evolution. The early part of this industry was just trying to get people to pay attention to Bitcoin, enable access, tell that story, get more people under the tent. And then we had a whole bunch of, in the post-Ethereum launch world, we had a bunch of ICOs that not a large percentage of the population, the investing population, participated in. It was very, very retail driven. That kind of went for a few years and kind of fizzled out for a while. You had a whole bunch of entrepreneurs launch new technologies that were not tested, but they were able to raise a ton of money. Some of that was coming from VCs, some of it was coming from retail. And as things evolve, the technology story became the story, and a lot of capital was chasing not a lot of opportunities. At the same time, people who were underinvested who hadn't been paying attention to the space were rushing in. And so that creates, high valuations. It creates these, enormous values. But some of the things weren't built yet, and they really haven't shipped. It was the promise. It was I'm going to tell you how the future is going to be, and it's going to be on my chain, and it's going to be all these different things. And not all of those things have come to pass. And so you have this glut of liquidity coming into a market with a very narrow kind of pinhole of real opportunity. And so that's kind of where we've been. As things mature, it's really hard to build $1 billion business in real life. It's just a difficult thing to do. You need customers, you need product that meets them, you need revenue, you need forecasting, and you need to do it quarter after quarter. It's slow, it's painful. Crypto didn't really have that. We were an enormous fundraising engine for a long time and an extremely successful one. And right over here, an enormous casino where anybody can participate in a venture type investment. And so it was storytelling, it was parties, it was a lot of fun. But the hard work, the painful part about building a business didn't always happen. And so we've kind of left the tell me stage and we're into the show me stage. Show me a discounted cash flow model. Show me a business plan. Deliver on your product. And so we're just like, it's like building a company again. And so capital is going to go where people are doing those things. It's going to go where consumers are asking for product instead of delivering a solution to a problem nobody has. And it's becoming more institutional. And institutional capital is going to be more selective. You know, I think putting the fraud on the side, it's a big part of our industry, and we have to acknowledge that. But the ones who will survive, you know, are the ones that are delivering value. They know who their customer is, they know who they are, and they're driving towards, you know, that end.
Yeah, I very much agree. Our background of our team is mainly coming from traditional finance banking. So I guess internally, when we evaluate a project, we've always been asking these questions like product market fit, what's the revenue model, etc. It was interesting, like 2-3 years ago, when I talked to other crypto VCs, they sometimes even think it's why do you even ask those kind of questions, right? you don't understand that's the next big thing. It's going to replace what we already have. So I think that a lot of I guess throughout the last cycle has proven that having like a solid business model, like what customers are you targeting, are the real kind of questions we should be asking. For example, like stablecoin, I think that's been proven out to be one like killer use case for crypto really in the last cycle. And then as Chetan mentioned, like RWA adoption, institutional adoption, this is where we spend most of the focus on coming to 2026.
So definitely everything that you're saying is resonating. There was a time in which the narrative was so strong and so much retail came in and it created so much excitement, and that is clearly not the time anymore. So it's very clear that at a given point in time, it's execution time. We're all going to look at what does revenue look like, what does a business plan look like, and at the same time, there's somewhat this feeling in this space like some of it is still very, very early. So as you're currently looking at potential token investment in the market, except for kind of looking at the business plan and looking at the future, what else would you evaluate to kind of say, this is a place where I want to place my bets?
Excuse me, sorry. I'll jump in. I think, yeah, what John and the others have said, revenue and actual product fit and proving that is critical now. You've seen that with Hype. You know, the two things I mentioned are strong tokenomics and revenue as the basic filter, because most tokens have supply unlocks or they have VCs that bought in super cheap and then they unload when the token lists. And so what you see is in Binance last year, every new listing, if you take the mean return, it was down like 95% just in 1 year for all of the listings. So that model doesn't work anymore. You have to have hard tokenomics. And this is even more important in crypto because there's no legal recourse over what you own. So obviously if you have a stock, you've got legal rights, right? If the company fails, there's something of value there that you can claim as a shareholder generally. That doesn't exist in crypto. As everyone knows, if the token fails, there's nothing. So you need strong tokenomics as a bare minimum, and that really means a fixed supply or some kind of burn model, which by burning the tokens obviously delivers value back to the token holders. So it's kind of like a dividend or a shareholder type pseudo model, if you will. So very few tokens have that. Very few. So the ones that do are the ones that have a better chance. And at the same time, they need revenues to show that they've actually got product market fit, and it should be growing, of course. So those two filters alone, like I said, you've only got a handful of tokens that meet it. And that's the place to start. I think you see, even then, it's an uphill battle in crypto, but they're the ones that typically stick around for years. Obviously, Hype is an example. BNB is an example. There's others. Not suggesting those as investments, but I mean, that is the model that is required, I think, for sustainability.
No, I think from the perspective of asset and wealth management, and maybe let's broaden that a little bit it's focusing on retail finance and consumer finance. I mean, I think we go back to the mantra of cheaper, better, faster, right? The blockchain was designed, or not designed, but it has the benefits of bringing faster execution, a cheaper cost to the end customer, and better experience. And I think that experience you're seeing with projects that are bringing DeFi into TradFi, and also conversely bringing TradFi clients greater access and a holistic view of their client assets, right? So what I mean by that is our vision of the future is a model where today you have accounts for everything. You have an account for a mortgage, you have an account for a bank, you have an account for maybe your crypto assets. That's not really a sustainable, or nor is it a really fun experience when you have to straddle all this way of dealing with your financial life. What you want is a holistic view in one centralized digital wallet that can take your assets and liabilities, and where, at least from an asset management standpoint, we can bring in liquid assets, illiquid assets, mortgages, liabilities, assets all in one, and then do portfolio construction around that. That's kind of the direction of the future. It doesn't always have to be all real-world assets, because I think the current need that we're serving is really DeFi clients who are now looking to diversify and want some sort of real-world asset portfolio into their DeFi mix. But it can also go the other way around. And I think ultimately where we'll end up is an ecosystem which is much more centralized yet decentralized on-chain, if that makes sense. And that's kind of exciting, because it's actually been a failure of most incumbent financial institutions today. They actually they have a vested interest in ensuring you're only looking at where you're sitting with them, not with where you're sitting on a decentralized basis, right? Like, if I asked you a question, what's your total asset level today and what are your total liabilities, you'd have to create a spreadsheet to do that. With on-chain experiences within the financial ecosystem, I think you can go much faster with projects that are aiming at that experiential level.
Yeah, I mean, just to kind of distill that a little bit, it's the tokenization of everything story is one that we very much believe in. We're an impetus and helping pave a way. We don't get to tokenize everything without regulatory wrapper and buy-in and harmony across jurisdictions. Our industry is borderless. That's the very foundational nature of like the Bitcoin story. But regulations aren't borderless. They're very much contained within a border. And so we firmly believe that better infrastructure, better software eats the world story, that's in the process of happening. It's the great convergence that you're seeing posted places like that. We're in the middle of it. It's happening. And banks aren't coming, banks are here. And so I think they already see the threat from this industry and giving people more choice, having to pay more yield back to holders of cash or cash-like products. Consumers ultimately win in the end, but it's kind of a long journey to get from idea to implementation to breadth of product. Franklin Templeton's a big part of that solution, but other big asset managers and banks themselves are on board. We're talking to 50 banks around the world about what their strategy is, and it's still early for them. Some are kind of still asking about what blockchain is. Some have an exchange and a custody offering and a derivatives offering already in-house. And so directionally, more and more products will come on-chain. I think more and more asset management and portfolio construction will be done by bots and agents. And so that kind of lends itself very well to trading these things and allocating them through a token. Customers don't care. Customers don't care which chain a thing exists. They care about, is it safe? Is it fast? Is it cheap? Is it reliable? That's what they care about, and that's where we end up. But we're in this transitional phase now before we get there.
Yeah, totally agree with John. I think we firmly believing we will see more assets on chain, but simply bringing certain things on chain doesn't solve the supply and demand issue. I think right now there's a lot of yield opportunities on chain, but I think the question is what's the underlying of those yield generations? So this year we're really trying to work with proper financial institutions, regulated entities, for example in Hong Kong, will work with China Pacific Insurance Asset Management, where they have their own like private credit assets generating pretty decent yield. And then what we're trying to do is to find the right chains and then like protocols with our kind of licenses in the US and UK as well, together with them in Hong Kong to do the proper risk management and distribution, and then also to unlock the incentives from on-chain sources. So we do continue to see like a convergence between TradFi and Web3, but then we have, like John said, we will have to do it in like a compliant manner. Also, we continue to see different type of assets moving on chain. For example, like private company shares. There's a lot of demand, especially in this part of the world, for like the biggest like private companies out there. So I know different parties are trying to solve the how to make make this kind of product more liquid and then more kind of regulatory compliant to serve this demand. So I think those directions are where we feel excited about.
I just want to speak to one thing about how this convergence, how this evolution happens. So, stable coins are its own use case for payments and a whole bunch of things, kind of a risk-off tokenized expression, because that's super easy to understand. It's the easiest thing for regulators to get their heads around, even though we still don't have, certainty in all jurisdictions. And then money market funds are like a natural extension, a yield-bearing instrument that has some of the same kind of easy to understand things. So you start with the easiest stuff, and you start with novel stuff. So tokenized private credit, for instance, is an area of growth where there just wasn't a real market for that before. You see carbon credits get tokenized. So you start with really easy stuff, or you start with greenfields, where there aren't really a bunch of products out there that are accessible. So I think that you kind of work towards the middle from both ends.
Absolutely. So it sounds like the two most repetitive terms over here are, we want to see the product market fit. We want to see users that really find fun and engagement, and it's easy and it's affordable, and at the same time, revenue. You would think that in a world that is so transparent, like everything that's happening on chain, it would be an efficient market where you can actually see the traction of the users, the revenue, and make decisions based on that. But at the same time, it looked like the transparency of on-chain, it created somewhat of an Instagram culture in which when everything is seen, people feel they need to fake everything. Specifically for us at Addressable, we're looking at the real users that are behind what's happening on-chain, and so much of it is fake, rewarded, and it's everything that the project owners, they want the world to see in order for traction to look good. And I think you, John, mentioned the word fraud earlier. When you're trying to evaluate the revenue and the product market fit with the data that's on chain, what are you looking at, and what are you looking at that's off chain to kind of understand if the revenue and the traction is real?
Is that for John or?
We can start. Let's start the reverse order with Stanley.
Well, I think when we evaluate a project, like I think pretty similar to I guess how not just like crypto project, we do like both token investment and equity investment. Actually, we have the same type of questionnaires how we approach it. For example, if you're saying like you're building certain products, we want to do like a interview with say your top customers or like whoever partners you work with. I think quite often for like crypto native projects, they are getting ahead of themselves. Like for what they're trying to build like a very big vision, but then they already like fundraising before they even have like the people that they will be working with. So quite often we, I guess, struggle with like those kind of projects. So I guess the principle is just going back to what we said earlier. It's really to find like what's your like who will be using your product basically, and then what's your business model? That's I think it's as simple as that for us.
Yeah, I mean, for us, it's knowing the teams, knowing the economics of how they're attracting, like TVL, for instance. You know, if your greatest feature is you're going to burn VC money to deliver it out to effectively buy market share, that's not a sustainable model, and that's kind of been an operating model for an awful lot of these protocols, and so that doesn't have lasting sustainability. And so it's getting to know what the vision is, understanding who their partners are and where the capital is coming from, and what the incentives are in the long term after you kind of get through the bootstrapping phase. Is it something that's delivering value that people want? It really is as simple as that.
Yeah, I think your question, I think, is more around the VC investment side of things and then some of the new projects coming along, which is an area we do have VC operations, but we, the area that I focus on, I'll take a slightly different answer to that question. In the world of real-world asset tokenization, the fundamentals of how the monetization occurs hasn't really changed, right? You take a money market fund, we're still generating the management fee on that project, if you will. In a world where the underlying securities ultimately get offered on-chain, and we are then deconstructing how we validate our presence in the ecosystem. By the way, so John mentioned AI bots. I certainly don't think we want AI bots. AI is a big theme. It's a whole different topic, but in the world of asset management, there's a role for that, but we wouldn't want AI bots necessarily to be taking the role of the portfolio manager, at least in the current.
Not yet.
Not yet. Different topic, different discussion. That said, I do think the economics can change, and I think it's all for the benefit of the end investor. Because one of the things we're doing is we've got one fund at 25 basis points, that's a traditional fund. You've got another fund at a 20% discount because of tokenization. Which one are you going to choose? It's the same exact fund. So we want to make that case pretty clear for these projects, if you will.
I come at it from a slightly different angle, I suppose. I think crypto and investors in crypto are fickle and it's very reflexive. So if Bitcoin is going down, all the other tokens are going to go down probably a lot more. We've seen that consistently. Like Bitcoin's down about 50%. Most tokens are down an order of magnitude 90% or more. So you need to be fluid in this asset class and I think really focus on what has survived long term. Bitcoin's been around and crypto 17 years now, which is a pretty long time in this modern technological driven era. So we've seen so many narratives and themes pop up. Last cycle, NFTs, GameFi, now it's RWAs, but even RWAs had a time as well in 2020. There was real estate going on chain, all sorts of things back then as well. So I think all of those themes have a place long term. I'm not convinced that it's in the near term necessarily that the value is there. I think if you look at what has survived and what is worked today, and the market is a voting machine, and it's more than 50% Bitcoin, so hard money, and it's also stable coins, which is obviously a really efficient payment processing. So if you add those two together, you've got most of the market. And the other themes, I agree, will grow and continue to scale, but the real value prop of crypto, in my opinion, is decentralized hard money and payment efficiencies. The other things are like added bonuses, but they're the smaller ticket items in the bigger picture. So, in terms of how we allocate and make these decisions and when to get in and out and look at projects, for us, it's a very data-intensive process of looking at macroeconomic data first. So it's top-down approach, Fed data, money supply data. Is that conducive of risk assets like crypto? And then it's layering on more data. So on-chain data, even credit spread and bond data, equities data is important now as well. And sentiment and technicals. So technicals alone are also a really important factor. And we feed this into ML and AI models now. So we already do a bit of the AI trading. But yeah, so I think you have to be fluid in this space and really focus on, if you want to be long-term, what is the things that have stuck and worked and how is the market voting on that? And that, for me, is stable coins and hard money.
So one of the things that we see around the industry that's changing is if you walk across the floor at the conference and consensus, you see the layer 2s are gone. Much less projects are speaking about retail. And suddenly all of kind of the business development guys that are usually around with hoodies are replacing that with suits and everybody's talking about the institutions. Chetan, if from the point of view of Franklin Templeton, when you're thinking about how the institutions are looking at all these projects, suddenly chasing them, how early are we on that? Is there a very strong appetite for that right now? Or is this still something that institutions are kind of thinking of, but it will take a bit more time? How do you see it?
Yeah, and I think as John also alluded to earlier, we're still very early, which is probably not a bad thing. I think we need to make the case we need to solidify the case, and I think we have as an institution. We started this nearly 10 years ago, so it's not new for us, but there are others in our universe, and there's hundreds and thousands of asset managers out there who haven't even started the journey. So I think it'll come. There's a lot of supply out there. We thought the retail piece would pick up the fastest because for the basic fact that, we're giving you something for cheaper, better, faster. What more could you possibly want, especially if it's cheaper? But it's really the institutional use case like collateral management, like corporate treasury, how to move money quickly, intraday yield, 4 times a day, instant redemption. Those are benefits that institutions are really looking for, including, for example, the iBenji collateral use case project that we have, which really gives an on-chain tokenized collateral option for hedge funds and crypto firms who want to use that for leverage. So it's those kind of use cases that have really sort of hopefully sparked the interest of institutional clients. The retail side of things, it will take some time. You've already got that from the DeFi side. You haven't quite gotten it from the TradFi set just yet.
And John and Stanley, this one is for you. It's very clear that capital is becoming more selective worldwide. But with the focus that you have in Asia, would you say that it's similar to the rest of the world or different? And if it's different, in what ways?
I actually don't think it's that different. I think we're just getting back to the fundamentals of investing. I think that's truer here than anywhere else. Asia's it's ridiculous, but it's a big population, right? We have 2/3 of the world's population on this continent, and the vast majority of them have mobile access. And so I think maybe there's more of a focus on consumer and bringing more people into financial markets than in the U.S. U.S. is the broadest, deepest capital market, and now it's open for business. And so I think so many capital raises in the last 4 or 5 years, and even further, have tied themselves in knots to not be a security. And that's why we see so much of the activity happening the way it's happened. Well, now the test factory is open for finding other ways to attract institutional money. That is definitely happening in and around kind of New York and kind of the global financial center. And so there's probably more experimentation happening outside, but I think we're just more open for business now, and maybe Asia has a little bit more of a slant towards the consumer.
Yeah, for us, I think Asia has always known to be like a big consumer market, especially across so many different countries. So we do see a lot of opportunities in like cross-border payments, especially between like the trading partners, China to Southeast Asia to Middle East, where a lot of people are using stablecoin already, and then the regulation across different regions are evolving. So I think if someone have like a cross-regional footprint can offer these kind of solutions, that'd be very interesting. And then secondly, I would just say, in terms of consumer adoption of new technology, if you look at China, for example, whatever like e-commerce model or ride-hailing model, they're always like the Chinese engineers. They always grind themselves to deliver the most kind of usable or user-friendly product. So it's great that we do see a lot of engineering kind of resources in this part of the world. And then we still want to see like the next crypto killer app, like really changing like how people live their daily lives. Be like, yeah, I was just talking to John like how to bring like say the K-pop culture to crypto. I think that makes a lot of sense for this region, and we want to support those kind of projects.
So I think when we discussed earlier about different use cases of crypto and where will that come to life, I think the terms of payments came up. But I think there's currently a lot of ongoing discussion about, is there a crypto beyond finance? Is the thesis of the read, write, own and other use cases, is it really there? Is it just early or it's never going to happen? When you were thinking about use cases in crypto that you'd invest in right now, thinking like 5 years or 10 years down the road, which ones of them do you think crypto would win in, and where would you choose to invest? Let's start with you, Charles.
Yeah, I think it's hard to take away the finance element of crypto. You know, even as long as 7 or 8 years ago, people were talking about blockchain instead of crypto, and how companies would use blockchain internally, and it just never happened. It's just blockchain is inefficient as a database, right? A normal database is more efficient if you're a company. So the real benefit is the financial layer and the tokenization and the whole package of crypto. Now, that may evolve in 10, 20 years, but I think in the next 5, 10 years, they're tied together. So, and I come back to what I said earlier, hard money, decentralized money. For Bitcoin in particular, the fixed cap supply, it's the only currency obviously outside of gold with a ultra low inflation rate, sub 2%. And it's the only thing that obviously fits in this modern world in terms of allowing instantaneous transactions, all the benefits that we all know for Bitcoin. So that's really the ultimate value prop, I think. And then on top of that, you have what stablecoins have done, which is obviously allowing for 24/7 transfers, low-cost transfers, and companies are now using that to pay their suppliers. So we're seeing the institutionalization of that layer, which is quite exciting. We've seen stablecoin market caps go up a lot. They've actually, in the last couple of months, pulled back, which is not a positive short-term indicator, but can be indicative that we're somewhat further through this pullback than, hopefully, than in prior instances. So for me, they're the two most important layers. And then the tokenization element, RWA, all those other benefits flow on in the longer term as well.
So from my perspective, and again, I'm not on the VC investment side, but from what I see within the firm, and outside of finance, so outside of all the applications you could use crypto for within finance, I actually think decentralized physical infrastructure it seems very alluring. Whether it is for like mobile networks, or for I think someone mentioned carbon credits. Well, how do you actually measure the impact of carbon offsets or carbon output? You can use decentralized physical infrastructure on the chain to create what is probably more a reliable and auditable mechanism to capture that data. So I think in that sphere of things, so whether it is mobile networks, telecom, data gathering, data verification, that to me seems the alluring part of crypto, or blockchain rather, that could have an impact.
I don't know if there's a galaxy view, maybe it's my own personal point of view, maybe it aligns with my philosophical leanings, but identity. And, not only owning your own information and not outsourcing that to, a third party. I think we've all grown up very happy to accept the free services of Google and Facebook, and you realize that, well, when it's free, you're the product. Yeah. And so taking that ownership back a little bit, and then just having ownership of your identity and enabling it to unlock a whole bunch of things that you do and interact with in your daily life. Additionally, kind of validating reality. We're in a world where it's very easy and inexpensive to create fakes, probably beyond what people are kind of aware of, and how good those are getting. You need something to be able to watermark, that this is actually me. This is my footprint. I work at Galaxy today. We had 4 fake Telegram accounts with people, pretending to be employees at Galaxy. And so we're just putting an APB out to everyone and say, hey, it's happening again. And so being able to have that validation layer and authentication is going to be very important as things get more complex and people are easily fooled.
Yeah, for us, I think what will be really exciting is like how crypto interact with AI. I think internally we already start to utilize some of the AI tools to do, like database work, or I think going forward there are many things we're thinking about, even like taking like a BD meeting, generating like research pieces. I think AI will integrate to like every part of our firm. Basically, I think that's what all we're trying to figure out how to do that. And then I think crypto provides a very useful tool for AI agents to interact and then to transact, which will be very useful in the future. So we're definitely looking out for how this trend continues to develop. And then I think that secondly is how crypto interacts with capital markets. I think last year what you see in the US, there are a lot of traditional capital markets vehicles, the DATs, etc. How to integrate the two kind of different worlds. It's to a last extent, it's happening in Asia. I think in Hong Kong, I think there are certain like regulatory concerns, which has been proven to be, I guess, right in some cases. But I think this trend will continue, like how to bring, like say, token project. Traditionally, you just go try to do a TGE, but now, like if you have a real product or like capital markets exit is like clearly another option. So I think that's what we expect to see more in like different capital markets in Asia too.
Perfect. So we reached the closing question, and how can you close with anything else but AI, right? So many narratives online with Claude's Opus 4.6 being so smart, outperforming all the previous models, and everything is shifting so fast. If you had to kind of take us 1 year moving forward into how will that change and revolutionize asset management, and in particular in crypto, both from the perspective of how does the role look and how will the market look? What will be your outlook for that? Stanley, maybe let's start with you.
Yeah, I think it will be really interesting. Like I guess I don't know, maybe in 20 years all of our jobs will be replaced by AI, but just a sequence. So we're still trying to figure out, at least in the short term, how to improve our own efficiency and understand like where the next breakthrough is coming from. So I think it's beneficial for us and the people on the stage where I think AI is really, there are like two kind of forces, one in the US and one in like Asia, right? Like just seeing like what different models are coming up, how you can integrate them to your existing business offerings, and then understanding what's the next big breakthrough. So for example, in the US, we are really trying to do like more partnership with universities, for example, talking to Berkeley and Columbia, just to be early enough to, even at the research stage, to support some of the AI research and where maybe we can invest as well. I think we're taking a similar approach here. We're talking to the Asia universities. That's how we position.
Yeah, I don't have a ton to add to that. I mean, we're in the, how do we integrate it into our processes? How do we become more efficient? It's probably not great for fresh grads who are looking, like investing is kind of an apprenticeship. Kind of people come out with lots of technical skills, but they're not very useful, and you need to sit beside someone and kind of learn how to model and learn how to think about a company, learn how to read a founder, get a sense of how committed they are to what they're doing. And so a lot of those kind of more menial functions and more, labor-intensive functions are starting to go away and become obviated. And so it's like we're in that part of it. And a year out is kind of a long time in crypto, a long time in AI world, the way things are developing. And so it's very hard to say, but we're in the efficiency and integration phase, at least at Galaxy, and even in my day-to-day life. I think AI will be more trusted over time, and be able to do complete tasks more over time. Now it's how do I kind of shorten the time to market for this thing, this deliverable, but that'll compound as we kind of give more responsibility to allow the AIs to work.
I know we don't have much time, but I'll make it really brief. So I woke up this morning and there was a great email sent by someone in the office around an announcement last night, and it was written by ChatGPT. And it was a beautiful memo. It was one of the best memos I've ever read in a while. So there's no doubt that AI is going to help with productivity gains, but it's not going to replace experience in the short term. In the long run, who knows? Yes, we may not even have jobs as portfolio managers, but in the short term, I just think it's going to be a productivity enhancement and a complement to experience.
Yeah, we are heavily involved in AI in our investment process. From day one, 5-6 years ago, we were doing reinforcement learning modeling. We've been using ML models in our trading for years. And of course, AI we've been using across the stack for tech development. Processes are much more efficient, but now we actually embedded it into all of our process and analytics. It's reading everything we do, all our metrics, data, over 30,000 pages of internal research and publications, and making investment decisions daily for Bitcoin and other assets. And we've back-tested that through extensive LLM modeling as well, and it's really performant. So it's actually quite exciting, and basically it's our only focus area now. I think AI for investment decision making is just going to take over the world, and the key factor will be who's leveraging it and who's got proprietary and useful data to add value to what's already there in an LLM. And having obviously experience in how to model and risk manage investing is obviously critical as well to layer on top. Google's CEO Schmidt, or founder Schmidt, said in the last week or so that within 12 months, most programs are going to be replaced by AI, and within 3 to 5 years, AGI will be in everyone's pocket. So I think if you take that view, it's hard to, people worry that AI is overvalued, but if that's somewhat of a most likely outcome, it's nothing in AI is overvalued. And I think for us, it's just the primary focus area. The capabilities that are coming out each month are obviously mind-blowing, as everyone knows. So for me, it's just critical to be doubling down on that space for investment management as well.
Thank you all, and thank you all for listening. Let's take a group photo.